So, what happens when your company's biggest market, the place you make most of your money, suddenly slams the door in your face with a massive 50% tariff? Well, that's the exact situation Apex Frozen Foods found itself in. This is a story about a whole lot more than just shrimp. It's really a masterclass in corporate survival, and it shows you how a single political decision can force a company to completely reinvent itself. Okay, so here's how we're going to break down this incredible turnaround. First, we'll look at the tariff shock that nearly brought the company to its knees. Then, we'll dive into the brilliant strategic moves that kept them in the game. After that, we'll see how everything changed, and we'll wrap it all up by weighing the bull case against the bear case, the potential upside versus some very real risks. All right, let's set the scene. Back in August of 2025, the company got hit with what you can only call an existential threat. The United States, which was by far its largest and most important market, just slapped a crippling 50% tariff on Indian shrimp. Overnight, the very core of their business was put in serious jeopardy. But here's the thing. Management didn't just sit around and wait for the storm to pass. No, they executed a really swift, two-pronged pivot. And this wasn't just about damage control, It was a fundamental redesign of their strategy to de-risk the entire business for the long haul. So part one of their survival plan was a super fast pivot to Europe. And we're not talking about a small adjustment here. They went out and secured over 100 new approvals for their processing units. And the result? Just look at this. Non-US exports ballooned to over half of their total sales. They essentially built a firewall against that American tariff shock. But just diversifying their customer base geographically wasn't enough. They also made a really smart move up the value chain. They started focusing way more on these higher margin, ready-to-eat products. This was absolutely critical because it protected their profitability and created a much more valuable product mix, even while their traditional business was getting hammered. And then the entire game changed. In February 2026, we got the announcement of the Trump-Modi trade deal. This was a huge turning point. It marked a sudden and dramatic end to that crisis period and completely flipped the script on the company's future. This new trade deal slashed that tariff from a crippling 50% all the way down to just 18%. And that one change, that instantly put Indian shrimp exporters right back on a level playing field with their major competitors from places like Ecuador and Indonesia. The market's reaction? It was immediate, and it was explosive. The stock just shot up, hitting a 52-week high as investors started to price in what they saw as a multi-year recovery cycle. They were basically betting on a huge comeback in the U.S. market. And you know what? The financial results quickly proved that the market's optimism was well-founded. The company came out with record-breaking earnings for the third quarter. Operating profits surged an incredible 175% compared to the same quarter last year. This was the tangible proof that the tariff relief was working. So all of that brings us to the forward-looking part of this whole story. With the crisis in the rearview mirror and profitability soaring, a really clear and compelling bull case for the company's future has started to emerge. So let's break down those core arguments. The bull case really comes down to a powerful 1-2 punch. First, you've got recovering sales volumes in the U.S. market, which is now wide open again. And you combine that with the higher margin business they were forced to build in the EU during the crisis. What you're left with is basically a resilient dual growth engine for the company. And there's one more piece to this puzzle that's really supercharging the bottom line. The company used its cash to aggressively pay down debt. This deleveraging has dramatically lowered their finance costs, which gives a huge boost to their profit after tax, or PAT. It's just a much leaner, more efficient operation now. But of course, no investment thesis is complete without looking at the risks. For a balanced view, we have to look at the other side of the coin. And right now, the current valuation is basically screaming that the market expects nothing short of perfection from here on out. So the primary risk here is pretty clear. It's valuation. Apex is trading at a price-to-earnings ratio of 55, which is more than double the industry average. At a multiple like that, the market has priced in perfection. There's just no room for error. Any hiccup, whether it's shipping delays or disease outbreak, could trigger a really sharp correction in the stock. So, what's the final verdict here? How do we put all this together? We've seen a company that stared down an existential threat, engineered a brilliant strategic pivot, and then got a massive tailwind from a political deal. Now we have to weigh that powerful growth story against a very demanding valuation. Our takeaway is that Apex Frozen Foods is really undergoing a fundamental change. It's shifting from being a cyclical play, a company whose fortunes just rise and fall with the volatile commodity market, into a structural compounder. That means it's becoming a more resilient business that can generate steady, long-term growth because of its new diversified model. Now, while the valuation looks high based on the past, it might just be justified if this is the beginning of a whole new era of sustained profitability. So the real question for investors is this: does this turnaround mark the start of a true multi-year growth story?